Stocks up, yields down. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Can the U.S. weather the storm?
There's a game of chicken going on right now.
Inflation was supposed to be moderating.
Now it looks like we're going into extra innings.
When I look at the earning analyst estimates, they're still too high.
We need to see some of that weakness coming through.
That should be the next shoe that drops.
We're not going to have a typical V bottom that markets have come to expect.
It's more of a slow car crash.
If you really start thinking about what's going on in the U.S. economy,
we're in this visibility vacuum that people don't know what to do.
The Fed is trying to hike and crack the economy.
This is presenting a real challenge.
It is more about the Fed right now than about U.S. growth.
It's just this uncertainty just keeps weighing on investors.
I think this progress is just taking a little bit longer than we thought.
Joining us now to discuss all-star panel to kick off the trading week, TPW's Jay Pulowski alongside Invesco's Matt Brill. Jay, first to you, buddy. Let's start with the U.S. economy. Resilient, standing up to abuse from the Federal Reserve. How much longer can it do so?
Well, John, we've been a believer in what we call the high nominal growth rate environment. We've talked about it for most of this year. It's different from what we experienced in 2010 to 2020. A lot of investors are having trouble grappling with it. Basically, it means that with the U.S. economy growing at a nominal rate of 10% or so versus, say, 4% pre-COVID, that earnings and sales growth are going to be okay. The bar is low, 2% consensus earnings growth. And we think it's going to be met and cleared easily. And ultimately, at this point in the cycle, that's what we're at. We're at the Fed on one side versus earnings on the other. The Fed is pretty much fully priced in. We're now pricing in a terminal rate of 5%. Earnings are going to be okay. And look, the economy is growing, probably going to grow 3% Q3. Yes, it will decelerate into 2023, but it's not going to be the deep recession that people fear because there's no big structural imbalance, whether it's consumer, whether it's corporates or banks. It doesn't exist in this cycle like it did in 08 and 01.
Matt Brill, your response.
Yeah, good morning, John. I agree with most of what Jay's saying there. I think, obviously the economy can continue to do well here. And the problem is it is really like a big game of Jenga where eventually you move the pieces around enough that, everything's going to come falling down. So I think that, we're at a state where it's not too late. The Fed is on the right path. They've been aggressive. And if we can get any signs of moderation in inflation, it's not too late in the game. But if this persists, you get another 75 in November, another 75 in December, another 75, potentially even in February of next year. That's when you get to the much more difficult period of time for corporate credit.
And Matt, what should I be worried about now then? Should I be worried about growth or inflation?
Well, you need to be worried about inflation because if you can get inflation under control, then you won't have a growth problem. And so, if we can just solve the first problem, then another problem won't ever get to that point. But as long as this goes on, it gets harder and harder to do that. So for now, we got to get inflation under control. And if we can do that, everybody, we're looking at valuations that are extremely attractive. So we just got to solve this inflation issue. And that's why last week's CPI print was just so disappointing.
We'll get to the valuation point in a moment. Let's talk about the solution. Jay, to have a solution that doesn't hammer growth, you need a supply-side evolution. Do you see any evidence of a supply-side story emerging that helps this Fed out?
Oh, 100%, John, and you're right on it. Look, supply chain breakage and collapse and confusion were really the story of COVID, and that's now cleared up pretty much across the board, whether you look at ships waiting at ports or container costs coming from Asia, all that's cleaned out and out of the system. So going forward, what we have, we believe over the next several years, is a high nominal growth world driven by a global CapEx boom to deal with the 3 C's of COVID, climate, and conflict. And we see it in the CHIPS Act. Everybody wants a semi-fab plant in the region. We see it with the battery plants moving the Rust Belt to a battery belt. Everybody has to have a battery plant for EV in their region. And this is what's going to drive CapEx, and that's what's going to drive growth. We see it and we've talked about it ad nauseum, as a analog to the second half of the 90s. We expect a productivity surge as we move away from work from home, and a pretty decent economic environment over the next several years. Something that, John, virtually no one, well, recently the economists, the FT people were starting to talk about it, but the mindset of the market is nowhere near that. The mindset of the market is back to pre-COVID, which we don't think is at all going to be what turns out.
To be fair, Jay, you were hoping for a globalized synchronized recovery, a global synchronized recovery this year, and Jay, that hasn't happened. You'd concede that. So can you tell me why you think that may or may not happen in the future?
Yeah, no, I mean, I think at some point a while back we were talking about that. More recently, the last 6 months, we've been highlighting, actually, John, the desynchronized global economy, both monetary policy, Fed and ECB tightening, yes, but Bank of Japan flat, standing pat, in the PBOC of China easing. So we always hear about how many rate hikes there have been. There's no talk of the fact that 50% of the biggest, most important top 4 central banks are not tightening. And then in terms of growth, U.S. and Europe slowing, yes, but Asia is picking up, whether you look at Japan, PMIs above 50, China or Southeast Asia. China's growth is going to be better in the second half than it was in the first half. So we actually, sorry to maybe to confuse things a bit, but we've been talking about a desynchronized global economy as being a support. And as we come through the cycle, as our other colleague just said, we come through the cycle, then we have the U.S. and Europe growing, Asia growing, and we have a global capex boom. Because again, you know our tripolar world point of view. Every region, Europe, sure, Asia, the Americas, needs a semi-fab plant, needs an electric vehicle battery plant. And that public-private investment, which we've seen post-COVID, now post-energy in Europe, that's the type of thing that's going to drive the global economy in the next several years.
Jay, you talked about the top 4 central banks. 3 of them have got one thing in common. They're dealing with a weaker currency, and the Federal Reserve is driving a much, much stronger dollar. This is what the president had to say about it. President Biden saying, quote, "I'm not concerned about the strength of the dollar. I'm concerned about the rest of the world. Our economy is strong as hell." Mike McKee, the problem is the rest of the world is concerned about the strength of the dollar.
Absolutely. Down at the IMF meetings in Washington last week, there were 3 villains: COVID, the Russians, and the dollar. The dollar, a side effect of the Fed's inflation fight, but one that is very important to the rest of the world. You can see that strong dollar periods coincide with slow global growth, and there's an IMF report out that says we could see, in a worst-case scenario, just 0.5% growth. Now, a global recession is somewhere between 1% and 3%, so 0.5% would be very bad news for the rest of the world. The IMF says about 60% of countries out there are in or near financial distress. Now, what happens? Well, the U.S. obviously has higher rates, attracting global investment. It's seen as a safe haven for investors, so anything that goes wrong, people want to put their money here, which means the U.S. exports inflation through trade, and the world pays more for commodities priced in dollars. So there is a problem out there. There's another problem for the president, though. The strong as hell thing? Maybe not. Today, Bloomberg Economics put out a new report that said the chances of a U.S. recession in 2023 are 100%. You get 60% from the Bloomberg survey of economists and 25% from the New York Fed. But you have to look back at when recessions start, at what level. The New York Fed is basically predicting recession. So are economists. It doesn't look good for strong as hell as the Fed continues its inflation fight. Biden needs a soft landing. The Fed would like one, but it doesn't look like, at least to the economics profession, that we're going to get one.
Mike McKee, thank you, sir. Let's pick up on that quote again from the President of the United States. "I'm not concerned about the strength of the dollar. I'm concerned about the rest of the world. Our economy is strong as hell." There's 2 points here. Matt Brill, let's go to the first one, and then we'll get to the second one. I'm not concerned about the strength of the dollar. I'm concerned about the rest of the world. What's your response to that, Matt?
Well, you know, as for the rest of the world, you've obviously got issues going on in Asia. You've got issues in the UK. I think that as far as the strong dollar, it never leads to a good market. It's debatable whether it leads to a good economy, but it doesn't lead to a good market. So we need the dollar to get hit here. We need the dollar to soften up in order for risk assets to reverse. So I think if you can get the dollar to reverse at all, then you're going to do well. But we just haven't gotten to that point yet, and because the Fed has to keep hiking, which is going to be good for the dollar. So it's a little bit circular here, but I'm thinking I think he's wrong with this, that he should be more concerned about this than he is.
Our economy is strong as how? Now, Matt, I guess it's a relative game, and relatively speaking, compared to others, it may well be. What do you make of that statement?
So he's absolutely correct. It is today. The question, will it be there in 3 to 6 months? And I still think that it comes down to this inflation expectations, and if you can get things under control, and they are out the curve expectations. We saw this. Michigan survey. I know you're not a huge fan of it, but seeing 500 people tell you what they think inflation is going to be over the next year, whether or not that matters, I don't know. But if you look at five-year forwards, they're certainly under control. So that is good. The economy is good now, and it's just the second derivative is starting to take place, so it's increasing at a decreasing rate. I think Biden, he's got an inflation problem. He does not have a growth problem, so he's going to tout the growth as much as he can while it exists. And right now, it still is very strong.
Matt, you brought up Mitch, so we can go there. This is not about me. This show's about you. Mitch, one-year inflation expectations, I believe, rose to about 5.1%. Matt, it's not for me to sit here and say, and I think these conversations often drift in this direction. Sit here and say what the Fed should or shouldn't do, what they should or shouldn't look at. They tell us they look at Mitch. Matt, they tell us they look at the ECI. They've told us they've made moves based on those two prints in the past 18 months as well. What's special about that move, Matt, getting back to 5.1%? What do you think it triggers within the Federal Reserve?
Well, I think it does make them certainly cautious, and they're seeing just no signs of victory thus far. And I think that's the biggest thing. The biggest takeaway is that if the Fed looks at 50 different things and not a single one of them tell them that they're winning, then that's not good. At the end of the day, the market really only cares about the CPI print, in my opinion. I mean, there's going to be others that matter. They're all undercards. The main event is the CPI print, and so we have to wait another 4 weeks until you get another CPI print. And so, for me, that's what the market's going to be looking at. The Fed can tell you all these other things, but all we really want to see is some signs that things are getting better, and we just haven't gotten them yet.
It was a knockout blow last week. Jay Pawlowski, just a final word on this one in this segment. 75 in November from this Fed.
Yeah, that's a given, John.
Jay Pawlowski, Matt Brill sticking with us. I think everyone is on that page right now. Coming up, trouble down to the UK. The Chancellor, Jeremy Hunt, ripping up the PM script.
There will be more difficult decisions, I'm afraid, on both tax and spending. The most important objective for our country right now is stability.
That conversation up next.
Taken together with a decision not to cut corporation tax and restoring the top rate of income tax, the measures I've announced today will raise every year around £32 billion. There will be more difficult decisions, I'm afraid, on both tax and spending. The most important objective for our country right now is stability. This government will therefore take whatever tough decisions are necessary to do so.
UK Chancellor Jeremy Hunt scrapping the Prime Minister's fiscal plans as Governor Bailey gets ready for a big rate hike.
The very clear message I would give, and it's a clear message for everybody, including it's a clear message for markets. I can tell you there is a very clear and immediate meeting of minds on the importance of stability and sustainability.
We will not hesitate to raise interest rates to meet the inflation target. And as things stand today, my best guess is that inflationary pressures will require a stronger response than we perhaps thought in August.
Team coverage starts right now with Guy Johnson in London alongside Lizzie Bird. And Lizzie, first to you. What a U-turn from this government.
Yeah, Jeremy Hunt's absolutely nuked Trussonomics here. You've had massive U-turns, more U-turns on even more of her tax cuts. And almost as humiliating, the energy bailout has been limited, so it's now going to be reviewed in April. It's going to be more in line with other European governments. Of course, it was really expensive. It was going to cost £60 billion estimated in the first 6 months. And what's humiliating about that is that even when Truss was having to U-turn on the top rate of income tax, corporation tax, she taunted Keir Starmer, the opposition Labour Party leader, that her energy bailout was bigger than his. And now she's kind of admitting that she's going to have a more targeted package so that businesses and rich households aren't having their energy bills paid for unnecessarily. The question is, do middle-income households who needed help become the baby that's thrown out with the bathwater. But notably missing from all of this was a reversal on the lifting of the cap of bankers' bonuses. So we'll have to see whether that's mentioned when Jeremy Hunt makes his statement in the Commons later on this afternoon.
We hear from him later this afternoon and then later on this month as well. And Guy, in early November, we hear from the Governor of the Bank of England in the decision we expect to be another big rate hike. Kit Jukes of SocGen said goodbye crisis, hello recession. Guy, the vigilantes win.
In some ways they do. Westminster is now basically being dictated to by the gilt market, by the City of London. Interesting relationship, considering we have seen that trade very much working in the other direction for a very long time. That's the trade right now. The Bank of England, if you look at current pricing, John, we have come back down to probably circa around 100 bips at the next hike. We are probably going to get up to around 5 to 6, somewhere in the middle. Let's call it 5.5 in terms of the terminal rate. It may need to be higher. What is interesting from the Chancellor today is he's gone further than maybe the fiscal hold would suggest that he needs to, suggesting that there has been some damage done, and he's talking about having to go even further. It's a wholesale reversal. I agree with Lizzie that the energy story is going to be an interesting aspect to all of this, and the bank will have to think about that as well, because that's going to limit the demand story coming out of the UK at the moment. It will hit consumers into next year when this programme starts to roll off in April. So that's going to have to be factored now back into the Bank of England's thinking on how far ultimately it can go.
Guy, I wonder if there's a difference between what the government wants to signal right now and what they're actually intending to do. Do you get the sense that they said April 2023 because they want to signal maybe a tighter approach to fiscal policy over the next several months, but they're fully intending to revisit that in the months to come?
I think facts will dictate that, John. We'll wait and see how tough this winter is. We'll wait and see what the situation looks like at the beginning of the next year. They have written a very big open cheque to the energy market, like so many governments have done around Europe. I suspect that this may give them actually a little bit more flexibility in terms of their ability to manage that process and be able to deal with what happens next year. I was talking to Maria Tadeo just a moment ago. She was talking about the fact that European politicians, they can't think beyond this winter. They know that there could be a problem further down the road, but at the moment, we just need to manage what is happening here and now. Let's see what the picture looks like in April. Maybe they do need to continue with it, maybe they don't.
It's a huge problem. Lizzie, Guy, what a couple of weeks for you guys, to the two of you. Thank you. Matt Brill, the bond vigilantes are back, and Kit Jukes of SocGen says the bond vigilantes win. I have to say, I've mentioned this a couple of times over the last couple of weeks, I can't remember a big change like this off the back of a market move in G7. In fact, maybe you've got to go back to Berlusconi and the Italian government and the Eurozone debt crisis when he got toppled. What do you make of this, Matt? The fact we've got the bond market, the pressure is back from the market to politicians in a way that it's been absent for much of the last 10 years.
Yeah, it's great for the longer term, absolutely, for fixed income. It feels nice to have a win in the fixed income camp for once this year. But, if you look, related to the U.S., at some point here, there's going to be discussion on whether, where the U.S. stands fiscally and do they need to be, tightening their belt. And I think this takes that off the table of somebody coming through with a very large tax cut or a very large spending increase. I think the bond market it doesn't have to do this in the U.S. because of what you've seen in the U.K. So hopefully we can avoid some volatility down the road, because I think this is the power that politicians need to see. And I think it's very healthy for the long term of the bond market.
Matt, I heard from several people in the last month or so that USIG was getting pushed around by what was happening with the pension industry and the crisis in UK markets. Any truth to that, Matt? And what does it mean now that the UK Chancellor has come out and done what he's done?
Yeah, it did. And in its simplest form, there wasn't enough long duration assets for UK pensions to buy. So they used some synthetics in order to do it. That caused leverage, and then they got offsides on that. So what they had also bought, though, because they couldn't buy it in the UK, was they bought long duration assets in the US. And so they were buying long duration corporate credit, and they had to sell it. And it was one of the few things they could actually get liquidity on in a short period of time. So we were seeing massive VWICs coming out, portfolio trades that were being done $1 billion at a time that were the market or the dealers just weren't ready for, and they didn't want to absorb it. So it really put a lot of pressure on corporate credit. Once we've got a little bit of reprieve over there, it's helped us. So for now we've got 99 problems, but gilts aren't one of them. But it's finally to the point where we're not selling off because of them. In fact, you got a 40 basis point plus move in long end gilts today. which is not healthy or not normal, but we'll take it for today. We just want some stability out of there, and then we can get back to trading where we think we should be on our own merit.
I'm not sure Jay-Z thought he was getting a shout out in the corporate and sovereign debt market this morning. Jay, I want to finish on Europe with you. You and I have talked about it together for so long, so many years. Guy's point on tightening up the duration of assistance to offset the pain in the energy market, and now it's only going to April 2023. Jay, the commitment of these governments in Europe to support the electorate through a difficult time, are you worried about the duration of it, considering this is going to go on potentially for more than one winter?
No, not at all, John. Look, we're big fans of what's happening in Europe, and I think part of the issue for the UK is, life post-Brexit is not easy. It's a small economy. It's a relatively unimportant economy. It's on its own, and it suffers as a result when it makes a policy mistake and markets react. It's really been what we called it 2 weeks ago, a tempest in a teapot. For Europe more broadly, look, all this is driving further integration. Now you're talking about Europe doing a unified missile defense shield. I mean, things that were unthinkable even 2 years ago. So we continue to be very constructive on Europe on a medium-term basis. Anybody with strategic money to deploy over a 3-5 year basis, Europe is trading the currency's 40% cheap. Stocks have never been cheaper versus the U.S. Integration is progressing apace. They have more fiscal support than the U.S. It's already pre-baked and is going to continue. And look, I think we're moving towards a Europe that issues debt in its own as a unified union. And as that happens, that's very constructive for the euro. That's very constructive for fiscal responsibility within Europe. And I think, to me, Europe, I said it before, and I continue to believe it, Europe has a chance to win the decade of the 2020s, particularly when you look at Asia and where the U.S. is.
I've got to frame what you just said.
Please do. I've said it many times, and I continue to believe
of what's happening in Europe. Jay Pawlowski, I'll frame it, and then we'll replay it in a few months' time. Jay Pawlowski, Matt Brill,
couple of years, buddy.
You want 2 years, you can have a couple of years. Coming up, the morning calls and later, Bank of America, the latest to report results. That conversation with Ken Leon of CFRA and PIMCO's Erin Brown just around the corner. Live from New York City, here are the morning calls. First up, JP adding TJX to its analyst focus list, saying the retailer historically outperforms during economic downturns. Morgan Stanley upgrading Clorox to equal weight, expecting margins to rebound as pricing pressure starts easing. And finally, Credit Suisse downgrading Fox to neutral, seeing an unfavourable backdrop amid growing recession risk. That stock is down by more than 5%. Coming up, more earnings from the big banks. PIMCO's Erin Brown recommending investors raise cash and remain defensive. That conversation up next, the opening bell just around the corner. "24 seconds away from the opening bell in New York City this morning. Good morning to you. Futures are positive, really kicking higher. Session highs up 1.8% on the S&P. On the Nasdaq 100 up by about 2.4%. On the rough sort of small caps up by 2 full percentage points. Off the back of a week of losses, looking to kick off Monday morning with a session of gains. Switch on the board and get to the bond market. There's your opening bell for equities. Yields are lower by 8 basis points on a 10-year, 393.85 over the previous 11 weeks. Yields have been climbing on a 10-year for 11 consecutive weeks. On a 2-year for 6. Unreal moves in this bond market. Twos all the way right out through the curve. In the FX market, euro showing some strength. Euro dollar up 0.6%, 97.84, and crude 86.70, up by around about 1.26% this morning. One stock to watch, Bank of America positive in early trading by about 5 full percentage points. For more on this, let's get to Bloomberg's Shonali Basak. Hey, Shonali.
Good morning, John. You're looking at Bank of America stock absolutely soaring early in trading, and it's because they're delivering above expectations. expectations on net interest income. And even though costs for the year are a little higher than expected, investors are showing you if you make money, you can spend some money. And so what does that mean? Headcount has increased slightly as well by the thousands, as it has in many of the other firms. But you're also seeing them say that they don't have plans right now for reduction. So again, welcome news. They're trying to stay competitive. They're seeing the consumer quite healthy here. You're also seeing FICC and equities meet or beat expectations. And so trading coming in above expectations, even some weakness being seen there in some credit and mortgage products. How that fares tomorrow for Goldman Sachs is of key interest because we're going to want to see them punch high on equities after what we saw at Morgan Stanley and JP Morgan kind of missing expectations there, and fixed income coming in strong across the board. Shifting over to Goldman Sachs, of course, that big news this morning about another reorganization around the corner. They have their earnings tomorrow as well. Key changes being unwound. They're merging again asset and wealth because the wealth customer, of course, has a slightly different profile, but consumer banking businesses will be in a bit of a separate region here in the bank, platform services area being created at the bank run by Stephanie Cohen, according to Bloomberg's reporting. So the big key question here is, fine, you have a reorganization at play, but what will this mean for the high hopes that David Solomon has hoped to hit $4 billion in consumer revenue by 2024? They're expected to meet $2.3 billion this year. Will he change his expectations as he addresses analysts tomorrow is the key question.
Shanley, what am I more interested in tomorrow, their numbers or the man delivering them?
The man delivering them, and it's not just the man himself. This is year 4 of his tenure, John. We're getting very, very close to year 5 of his tenure. This is the part of the history here for David Solomon where you start to take note. They've come in above expectations on returns on equity consistently. Their bank, however, is trading below book value. How does he get the multiple that many of his rivals are getting? Is the investment bank simply not enough for Goldman Sachs to give investors what they want?
Shanali, looking forward to your coverage through tomorrow. Shanali Bassett will be on with us on Bloomberg Surveillance as we break down those numbers for you. Sticking with us on the banks is Ken Leon of CFRA. He joins us now. Ken, was fortunate to catch up with you last week. We get to do it again this morning. Just your view on Goldman, the leadership, the direction of travel as we go into tomorrow numbers.
Yeah, so analysts are still listening to Bank of America, but top of mind is Goldman Sachs. And for Goldman, you know, I really think James Gorman at Morgan Stanley has a chuckle here. He's got the right strategy. Goldman just reached too far trying to get scale from nowhere in consumer banking. And obviously that has a good long-term opportunity, but they can't bring it to revenues or profitability. Gorman, of course, acquiring E-Trade gets the workforce. They're able to get into different segments of wealth. And the market, as Shanali mentions, pays a higher multiple for principal businesses or recurring revenue. And unfortunately, investment banking is going to be challenging through next year for Goldman and others. And they're essentially combining businesses with trading so that they can begin to cut costs.
So, Ken, what are you saying? Are you saying it's the wrong strategy? Are you saying they should have brought this? They shouldn't have done it organically? Does Marcus need to go? Ken, what are you saying they should do?
So Goldman is always a brilliant, best in class, but they basically have an agency businesses, and they see others like BlackRock or Schwab or even Blackstone enjoy the benefits of scale and recurring revenue. In a very cyclical business, which will be down through next year as investment banking, they don't have the #1 wealth business as Morgan Stanley has, or the broad scale that Bank of America has in commercial and consumer lending, or JP Morgan. We have buys on Bank of America and Morgan Stanley. We took Goldman Sachs from a strong buy down to a hold over a month ago, just feeling that the agency business is just not going to come around. And it's a big leap to say that you can, you know, have a slightly higher rate to a consumer that's a spender or a saver, but not yet an investor for the long-term trend. That was really a tough strategy.
Ken, Bank of America right now is up by more than 5%. Can I just ask you, for these big banks like B of A, are higher interest rates good or bad for them in the next 12 months?
Yeah, we stay with Bank of America because, as you know, essentially, if you have a large, high-quality loan book, you can sit back and enjoy rising rates. But obviously, the risk is any cracks or severe recession next year. We will have recession if it's not severe. What Bank of America said is we're going to add another $1.25 billion of net interest income in the fourth quarter. So that was always part of the bull case, which was rising rates. But you know, unfortunately, next year, economy is going to slow down, and that makes it a little more tenuous. And then the capital markets, you know, we like, and I think a lot of portfolio managers like regional banks over the large banks because of geopolitical risk and also underperforming in investment banking.
Ken, what we're used to in a recession is a central bank cutting interest rates. And when we backtest and look at how these banks respond to downturns in economic growth, usually that's supplemented by interest rates being cut at the Federal Reserve. Ken, have you given thought to a cycle where we get a recession, the Fed doesn't cut, and what that actually means for the banks this time around?
So they will then be part of perhaps, you know, a new bull market or a recovery of the economy, and we're not there yet. And, you know, there's a generational rise of inflation. Many investors have not been around since we've seen the 1970s or 80s, and the Fed's credibility is at line. So I think, you know, we're looking at 75 basis points in November, maybe December, and, you know, that's the challenge. I think a lot of us hope that the Fed will ease, but, you know, there's a lot more work to be done. And unfortunately, that's not great for the financial sector or banks until we see them pause.
Ken, awesome to hear from you this morning. Thank you, sir. Ken Leon there of CFRA. Bank of America positive by 4.7%. A broader story 6 or 7 minutes in. We're up and away on the S&P 500, up by 2.5%. On the NASDAQ, up by 3% and some. PIMCO's Erin Brown says stay defensive. She writes the following: companies have to navigate an extremely difficult environment where demand is slowing, fading, and cost pressures persist. Thus threatening margin contraction. We are underweight more cyclical sectors and favour high-quality companies at reasonable valuations. Erin joins us right now. Erin, thank you for your patience as we work through the financial stuff. Let's get to the equity market. Big move higher. Are you saying you'd fade this?
I absolutely would fade it. I think that the market right now is just coming off of, you know, very strong weakness over the past week. We see a little bit of a relief rally this morning, but I wouldn't extrapolate that this is, you know, going to last a very long time. I still think that there's significant challenges ahead as we turn the corner into early next year that the market hasn't digested yet. Earnings estimates are too high, margins expectations are too high, and I don't think that equities are still, you know, singing the same from the same hymn book that we see in the fixed income markets. You saw a very negative reaction last week on the CPI print and sort of follow on into Friday. And I think what you're seeing is that the market is still fearful of higher inflation and still believes that higher inflation is going to, you know, lead to or accelerate a recession. And I think that that's the challenge that the market's still facing that we, you know, we'll see unfold over the next couple of months. So I still think that there's about 10% downside from current levels to S&P 500.
Erin, in the near term, is there some upside at all? In the very near term, because Mike Wilson of Morgan Stanley shares your view, ultimately, that there's more downside here and maybe we could get down to 3,400. But he wrote this morning. He said the 200-week moving average is a serious floor of support until companies fully confess or a recession officially arrives, both of which could take several more months and lead to a technical rally in the short term. Erin, you've given me your fundamental thesis. What about your more technical, tactical thesis about the short term? The scope for an upside move here?
Yeah, I mean, I definitely think that there's scope for upside move. A lot of people are pointing to that 200-day moving average. On top of that, earnings expectations for this quarter are quite muted. There's only, you know, sort of low single-digit earnings expectations. While earnings have been coming in slightly weaker than expected, you know, the bar isn't that high. And so, you know, going into what typically is a very strong seasonal quarter, which is the fourth quarter, and into, you know, a fairly muted earnings season, there's certainly potential for upside, but, you know, it's hard to time that, and I would be fading or selling into any of that upside move that you see in the market on what I think is largely a technicality.
What's going to lead you to drop your neutral stance on duration away from the equity market, Erin?
I think we're getting closer to that point. I think you really need to see a couple of things happen to get more bullish duration. The first would be to see inflation really peak and have a credible path lower for inflation. You know, there's been sort of 3 times now where we've had these head fakes with respect to inflation peaking, and yet we've been met with disappointment. And so I think until we see credible signs that inflation is really moving lower, it's going to be hard to really, you know, put your neck out there and buy duration and size. But given the valuation levels, given these real yield levels that we're seeing today, it is arguably a pretty attractive alternative to other asset classes. I mean, if you think about it, historically, your starting point for yield today is what the market should bear over the next 10 years or so. So given, the starting point of 4.4% on the 2-year and just below 4% on 10 years, that's a pretty good return that you're getting from cash and duration over the next 10 years, albeit with volatility in the near term.
Erin, just a final question on that. I hear a lot of people say raise cash, stay defensive. With the benefit of hindsight, that's super useful 12 months ago. Erin, there's people watching this now who just don't want to monetize the losses this deep into the hole. How do they raise cash?
I mean, I think that we're still going to see downside from equities from here. So I think taking money here out of the market and putting it in a 4%, 2-year paper still makes sense. And I think that, alternatively, looking at high investment grade corporates that are also yielding, a 6%, 7% yield also makes sense. Staying, shorter term in duration. But if you expect more downside from here, yes, it's painful. Use that to tax loss harvest, and cycle that money back into products that can earn a sustainable yield and return over the next 6 to 12 months while you wait it out.
Erin, awesome to hear from you, as always. Erin Brown there of PIMCO. Your equity market about 11 or 12 minutes into the session, up by 2.8% or so on the S&P. Big move higher on the Nasdaq, up by 3.33%. Coming up, the White House throwing its support behind the Fed.
The big concern is, can they bring down inflation while maintaining a robust economy, labor market? We are starting to see signs that the actions they are taking is having an effect.
That conversation up next. Plus, we'll catch up with Oppenheimer's John Stolfus. His S&P 500 price target getting chopped from 4,800 down to 4K. We'll get to him next.
This is Bloomberg's The Open. I'm Angel Feliciano. You're looking at a live shot of the principal room. Coming up, Anna Button, Banco Santander Executive Chair. That conversation is at 12 p.m. Eastern, 5 p.m. in London. This is Bloomberg.
What we can see in the economic data is the Fed is focused on bringing down inflation. And the big concern is, can they bring down inflation while maintaining a robust economy, labor market? And we are starting to see signs that the actions they are taking is having an effect.
Division down in D.C., there always is. The Biden administration back in the Fed saying its policies are starting to work. Senator Bernie Sanders seeing a different picture.
I think they're hurting the situation. I think that it is wrong to be saying that the way we're going to deal with inflation is by lowering wages and increasing unemployment. This inflation thing is a real issue. It is a global issue. But at a time when working families are struggling and the people on top are doing phenomenally well, I don't think you go after working people.
Mike McKee with us here in New York City. Mike McKee, the usual suspects maybe Senator Warren, Senator Sanders, but ultimately we're expecting more of this, aren't we?
Yeah, it's starting to be a debate in economic circles as well as people start to think about what could happen. It's not happened yet, but Bernie Sanders has some support, particularly among progressive economists. Claudia Sahm, you've heard of her. She's fairly grumpy about things right now. She says the world's bad and will worsen at home and abroad before it gets better. Time for the Fed to do the right thing and slow down. Is the Fed going to do that? Well, not what they're telling us. It does suggest, I mean, in the past, that there is a danger of what Bernie Sanders and Claudia Sahm are talking about, because when the Fed raises interest rates, unemployment goes up, we go into recession. The Fed so far raising interest rates, though, and it hasn't happened. And that's the dilemma for the Fed. They believe that people are better off if they bring down inflation, even at the lower end, because while people are making more money, they are not making enough to keep up with inflation. So if inflation comes down, then everybody is better off. And so that's the goal for the Fed going forward. They're going to watch the unemployment rate, but they think it'll only go to 4.4%. That isn't very much by historical standards, and it may be about normal. We may have a tighter labor market than people think. So it's something that has to play out over many months now, but it is definitely a growing debate, particularly down in Washington.
We're going to have this conversation a whole lot more going into the midterms, no doubt, in the next couple of weeks. Mike McKee there, here in New York City. And great work, Mike, last week in D.C. More bulls throwing in the towel, kinda. And I'm going to get to the kinda in a moment. But Oppenheimer's John Stolfus was at 4,800 year end. He's chopped that down to 4,000. His price target now is 4,000 year end. And I'm happy to say that he's given us a bit of time this morning to talk about it. John, great to catch up, sir. Thanks for taking the time to be with us. So let's start here. You know, I've talked about this a few times over the last few months. What was the straw that broke the camel's back on this one?
I really think it has simply been that we have seen repeatedly these rallies that we've had that have been remarkably powerful based on the negativity that's out there. And then they weren't sustainable. And it simply weren't sustainable because the issues at hand, whether it's monetary policy, a generally more aggressive stance and committed stance by the Fed to curb inflation, as well as political dysfunction in Washington and abroad, the geopolitical stuff, supply chains that are still not quite up to pre-pandemic levels. All this, you know, it gives pressure and concern to the market. So what we've got to think is, you know, 12% upside from here to the end of the year makes a lot more sense than almost 33% upside based on where the S&P closed on Friday. So we're still bullish on equities. It's just going to take more time until the Fed has effect on curbing inflation, because those last numbers from last week, the 30-year yield, the 30-year mortgage yield last week going up again, just doesn't look like it's had effect yet. We believe it will have effect, but not yet.
John, you and I have talked about this and discussed it through the year. You know, not everyone gets the year right. That's just part of the game sometimes. But, John, you got it dead wrong. And I just wonder what you feel like you did get wrong and didn't learn from quickly enough. As you reflect on this year and think about the years to come, how will you and the team grow from it?
Well, the first thing I'd remind you, John, we've been pretty accurate over most of the 10 years that I've been here at Oppenheimer since 2012 in terms of the direction of the S&P 500, except for 2015, 2018, and this year. So not a bad record. And last year our target was 4,700. The S&P closed at 4,776, as I recall. This year we got it wrong very simply. We could not have expected the Russians' incursion into Ukraine, zero COVID tolerance by China that closed down the city of Shanghai, a city of 25 million people, plus the effects of overstimulation by the Fed and by politicians who just couldn't let go of the fiscal policy.
The reason I asked, John, is because 2015 was a down year. 2018 was a down year.
Yeah,
and what worked last year was just being
flat.
What worked last year was just being bullish and strong, and what worked for the last decade was to be bullish and strong. And John, I just wonder if we'll all adapt into a new market regime, a real change.
Well, the big regime is it's the end of free money, and the end of free money means you're deleveraging in a wide variety of areas that have inflated the valuations of things like meme stocks, cyber currencies, as well as even core assets like equities, bonds, real estate, and a number of other assets. When you take out the leverage that the Federal Reserve has enabled and the largesse of politician stimulus, it means that things move back to reality. It doesn't mean stocks can't move higher. It doesn't mean companies can't earn money, but there's a period of adjustment that we've witnessed here that is taking longer. You know, when you look at the Fed has raised, what, 5 times so far? And still has had very little effect on the rate of inflation. And that's where we are. The market's responding to that.
John, 300 basis points in 6 months is a lot.
Oh,
We've had a lot done in a small period of time. I get that. But I just want to really sort of hit home on this, and you and I can talk about it in the future as well, because we don't have too much time. But being married to a worldview in the last 10 years generated some real gains. And if you were just long the whole decade, you would have been down in 15, it was a down year. 18, it was a down year.
Now I feel like basically flat.
Sure, it was a flat year, slightly negative by about 0.7 of 1%.
Was actually positive.
We can argue over the details, John, but you know where I'm going with this. I'm just wondering whether the perma bulls have got to rethink their worldview based on what's happened over the last 9-10 months.
I'd say we were not perma bulls, but rather we were positive on a pretty obvious situation. In terms of moving forward, we'd think past performance no guarantee of future performance, would suggest that once the market gets used to this new regime of a world in which bond issuers have to pay for the privilege of borrowing money, and bond buyers get paid for the risks they take, and that moves through the credit facilities, of course, affects equity returns, the market is likely to return to a more positively adjusted basis. You know, I've been doing this for 39 years, so I can remember where interest rates were a lot higher than they are now. Bonds were yielding yields much higher than now, and stocks were moving up.
Hey, John, credit to you for coming on with us this morning. I appreciate you know that. And we're going to have a longer conversation in the future. John, thank you, sir. John Stafford there of Oppenheimer from New York. This is Bloomberg.